What up, Tile friends? Welcome back to another Hump Day Financials brought to you by Performance Financial LLC. I got Drake Van Hull in the studio with me. What's up, Drake?
Dude, doing great. How are you doing?
Doing good, man. I'm enjoying this series. We got a 4-part series, and we're on the 3rd week. What are we talking about this week?
So we're going to be talking about our statement of cash flows. Very underutilized report, but I think what it's going to do for you guys is really give you a good understanding of what is happening to your cash inside of your business. And this is a great report to really understand kind of the 3 components of where your cash can go.
Nice. All right. I'll throw it up on the screen and we can dig into it.
Awesome. So we're talking about Craig's Design and Landscaping. I'll reiterate this for the 3rd time. This is not a client. This is a made-up account, and it's one that I can kind of share with you guys. So again, I wouldn't share client information with anybody, but we'll dive into what the heck even is the statement of cash flows. This is probably a report you guys haven't heard of, right? Mm-hmm. If you have, kudos to you. I'd love to hear about why you know about the statement of cash flows. But this is a pretty standard report. If you were going to have an audit performed, like an actual CPA firm coming in and preparing an audit, this would be a report that you'd want to see. If investors are coming into your business, this is something that they would want to see. Ultimately, what this report is telling the user is, what are you guys doing with your cash inside of your business? So I always like to joke, there's 3 things that you can do with cash. You can save it, you can spend it, and you can give it. And that's kind of what this report is helping us understand. So first, we'll start with the first kind of category. This is your operating activities, right? So this is things like, the first thing you're going to see is your net income. If your business is profitable, right, in theory, your cash should be going up from the profit of that business, right? And that's what we're seeing here is if you jump back to our last episode, Craig, they had some profit for their year of about $1,600. That profit is bringing cash into the business. Now we'll kind of look at some of the other activities that you'd have inside of your operations that could either bring or take out cash of your business. So things like accounts receivable. So this is what these 2 reports are kind of doing is we're evaluating the balance sheet and kind of the income statement on how those 2 interact from cash. So if our accounts receivable goes up, really any asset, if they go up, that means cash is going out the door, right? So think of those as kind of having an inverse relationship. And if we think about it, if we give out a receivable, it means we're probably getting some sales. It makes our profit go up, but we haven't received any cash. So that's why you're going to see this negative number. If you compare kind of their last year's statement of cash flows, they probably had no receivables last year. This year, they got $5,200 in receivables. Means, hey, we got money we're waiting to collect. So our cash in theory has gone down. Same with inventory. They bought inventory. Means our cash goes down. Now with debt or current liabilities or anything like that, when those liabilities go up, it means our cash goes up, right? So if we have some items that we purchased from a vendor and they say, hey, don't pay me till the end of the month, you have 30 days to pay. Well, we've gotten something and we haven't sent any cash out for that item. We just have a promise to pay. So that has made our cash go up. So that's where you're seeing our accounts payable. That's a positive number. Our credit card, that's a positive number. We owe some money maybe to this board of equalization. And then same with some loans that we have to pay. They're future needs for cash. But when those go up as compared to a previous period of time, then our cash goes up. The next section that we have to look at is our investing activities, right? So these are things like, are we buying equipment, right? When we're buying vehicles and equipment inside of our business, we're investing inside of ourselves, right? So cash is going out the door when we're buying those things. So that's why we're seeing like this truck original cost at almost $13,500. That's money going out the door to buy those assets. And then when we sell those assets, then that money that comes back in, that's typically where you're going to see a positive number in here. The third category is financing activities. So it looks like Craig and his business, he took out a loan, right? He took out a note payable, probably used some of that to help buy this truck and maybe to fund the operations to start the business. So that is cash coming in the door, right? Some loan company or maybe a family member gave him some money. It's not a sale. That's money coming in the door through financing activities. So when you pay down those debts, that would be a decrease to your cash. What I want to make really clear and why I think this statement of cash flows is really important, especially for you guys, is one thing that is not an expense is debt payments, right? So if you look at your income statement, if you guys don't have any receivables, if you don't have any inventory, if you don't have any credit cards or payables, your income statement is going to mimic this statement of cash flows almost identically, right? If you're just dealing with your debit card and checks, your income statement's going to match up this statement of cash flows almost identically, because the only thing you're going to have to worry about is what net income's doing. However, when you have receivables, when you're buying inventory and holding it, when you are taking out debt, those things are going to impact the cash flow statement and not the income statement. Because when you take in money from debt, that doesn't reflect on our income statement. That's just a balance sheet transaction. When you make payments on a truck or equipment payments or on a credit card, those payments are not the expense, right? When you buy a truck and you make your monthly payment on it, that monthly payment is not reflected in your income statement. That cash that goes out the door is not an expense to you. It is a pay down of debt specifically towards your balance sheet. So that's where this statement kind of helps you understand, okay, we're really profitable, but our cash doesn't seem to ever go up. Why does our cash stay stagnant? Well, it's probably because you might have a lot of receivables, you got a fair amount of debt, and you're paying down that debt with the cash that the company is making, but you're not seeing those payments on your debt decrease your profit. So this can help you kind of understand, okay, well, we're looking profitable. Why is our cash not going up? Well, we got a bunch of money sitting out in receivables. We bought a lot of inventory. We had made a lot of debt payments on our equipment. That could be a good reason why your cash isn't going up while your profit's going up.
That makes a lot of sense. Yeah, this is one that I am not familiar with, but I can definitely see, its utility for sure, its value.
And again, I'll reiterate this for you guys. You're probably not going to see this level of detail if you go pull this report, right? I mean, they're trying to make this company look a lot more vast than it really is just because it's a demonstration company.
Sure.
You're probably just going to have maybe receivables, maybe some credit cards, and maybe a little bit of notes payable. But it's mostly going to be net income and maybe some debt. I mean, that's going to be the biggest extent of probably your cash flow needs. And so understanding that debt is not an expense when we pay it is the biggest thing that's going to help you understand what is truly happening with your cash on a month-to-month basis or a week-to-week basis or whatever it is that you're evaluating it on.
And it looks like this is another one like the profit and loss where we're looking at a period of time. How often would you recommend? Is this another monthly something to view every month? I mean,
this is a monthly or a quarterly one. I think the biggest thing with your statement of cash flows is really understanding what is it trying to tell you. And I think the biggest thing that's trying to tell us is there are a lot of different things that can impact our cash. Most importantly for our listeners, I think, is it's going to be our profit, and then debt payments are the biggest pieces that are going to impact our cash. The income statement, if you don't have any debt and you don't do any receivables, you get paid when all your jobs are done, that profit and loss is going to basically be your cash flow, because it's just going to be, if we're profitable, that means cash is coming into the bank. But if you do have some of these types of accounts, those are going to impact where your cash balance sits at. And again, I'll reiterate, cash is king inside of our businesses. And so understanding where is our cash going out, we do that one through just looking at our expenses on our income statement, but also understanding the other components that can affect our cash, like buying vehicles, paying down debt, not getting any receivables paid down. Those are impacts to our cash, and understanding those as we look at our income statement and our balance sheet really are helpful drivers. And this statement really just gives us kind of the background as to what they are.
Nice. All right. Well, thanks for breaking this down. This is a great third series in a 4-part series. What will we be checking out next week?
So next, we're just going to wrap it all up together, right?
Okay.
And talk about how they're important as part of your actual review and evaluation of your company, right? You may be going, Drake, my company's too small right now, or this seems like I'm going to spend an hour doing this a week. And I'm going to tell you, yes, that's exactly what you should be doing. So we'll talk about that more at our next talk and help you get a better understanding on these.
Yeah, such a great point. Coming to understand and evaluate the company. And even though you're small, that was the point I wanted to bring out. Even though you're a small company, from day one, if you have dreams and aspirations and a vision for a larger company, start acting like it today.
Exactly.
All right, Tile friends. Well, this was another Hump Day Financials brought to you by Performance Financial LLC. If you're in need of a CPA or a financial advisor, get a hold of Drake Van Hall. The link is in the show notes to his website. Drake, you take it easy, and we'll talk to you next week.